Hello everyone, investment scams rampant. Please vigilant and discerning. Do not trust information from unknown sources. Please make sure recognize 2 official Capital Securities community, Facebook, Capital Securities, YouTube, Capital Wealth Insights.
All right. Good evening to all the viewers of Capital Securities Good Evening program. Good evening, everyone. Today is Tuesday, September 9th. After yesterday's U.S. stock market, which continued to perform quite optimistically, today we're going to discuss a topic that's closely related to this week's economic data. First up, we'll talk about the annual revision of the non-farm payroll numbers. With this annual revision, we can go back and review the past performance. For example, we can look at how things went in previous years, and then see whether what Trump said during his second term made sense, as well as his recent actions, whether it's his interventions with the Federal Reserve, the messages he's been sending out, or his moves in general. Will these things affect the overall interest rate environment going forward? And what about the economy's direction? Next, for our second topic, we'll look at recent sector performance. Focusing on the last 5 trading days, we'll share that with everyone shortly, looking at both popular and less popular stocks, and also making predictions. Will the US CPI data to be released this week bring any surprises, shocks, or unexpected reactions to the market? Let's explore and discuss this topic. First, let's say hi to a few viewers. Hello to Hector, our staff, Hee Woo, Alice Hu, and Kay Coco. Good evening, everyone. It's great to have you all here to discuss some information about the US stock market together. Alright, first let's take a look at the one-year inflation expectations released yesterday by the New York Federal Reserve. Actually, it has ticked up a bit and is higher than expected. We can see that the previous survey put it at around 3.13%. This is based on their survey about expectations for the coming year, regardless of whether it's from consumers or the data collected from their clients. So, in fact, the results of this survey are actually a bit higher than previously expected, at 3.2%, whereas the previous release was 3.09%. So, regarding this kind of future inflation expectation, we can see that there is already a trend of it starting to rise. It's a slight increase, not out of control, just a slight uptick. Let's take a look at the conclusions they provided in the report. Here it mentions that in August, consumers' expectations for inflation over the next year rose from 3.09 to 3.2, as we just saw. But it also mentions that, regarding employment, the outlook is pessimistic. Why is that? They believe that, according to the survey of these consumers, if someone loses their job, the percentage of respondents who think they could find another job has dropped significantly, by 5.8 percentage points. Originally, it was just over 50%. Now it has dropped to 44.9%, close to 45%. But this is the lowest reading for this indicator since 2013, which is more than 12 years ago, since this statistic has been tracked. So this subjective expectation regarding employment actually reflects their view of the employment situation. For example, if I lose my job, the chances of me finding a new one are not optimistic. In fact, it's already below 58, the lowest in 12 years, so it's pessimistic. This is in line with the non-farm payroll data that came out last Friday. In fact, they match up perfectly. The two are consistent. Because with the new non-farm policy, the number of new non-farm jobs was actually only 22,000, which is also much lower than market expectations. Later today, the annual adjustment will be released, the revision, which covers corrections up to March. In other words, it's roughly the numbers from the first 2 or 3 months since Trump took office this year, basically about 2 months worth of data, which is during Trump's second term. As for the earlier period, like from April to October 2024, and even up to the end of the year, that was during Biden's term, before the presidential transition. Now, aside from employment, where the subjective outlook is rather pessimistic, let's take a look at something else. For the coming year, what other expectations do consumers have about prices? Well, they think the gasoline, since so many people in the US drive, and not having a car is almost like being unable to get around, will go up by 3.92%. As for daily necessities, the increase is 5.53%, which is pretty astonishing. But these two items, gasoline and daily essentials, are often excluded from the CPI or general price calculations because their prices fluctuate a lot. So what about items that are used more regularly and aren't excluded? Medical expenses have gone up by 8.8%. That's shocking. This is considered very high. So, people expect hospital costs, whether medication prices, surgeries, or medical fees, will keep rising. And the rate of increase isn't low either. In addition, college education costs have also risen by 7.8%. As for housing, whether it's buying a home or renting, rents have gone up nearly 6%. So, in terms of prices, according to the survey released yesterday by the New York Federal Reserve, whether it's about jobs or prices, for the average American consumer, people are generally feeling pretty pessimistic. We'll actually discuss this topic with everyone a bit later. Alright, next, let's take a look at the decline in non-farm payroll numbers. Some institutions actually have slightly different views on this, but as mentioned here, institutions like Wells Fargo or some economists from various organizations believe that the current estimated figures will be revised downward by about 800,000. They think the monthly average might drop to as low as 60,000 to 70,000. CSC Financial, Bank of America, and Canadian Imperial Bank of Commerce are even more pessimistic. They say the downward revision could be close to 1 million. These are institutional views. In the middle here, these are generally the views of the big Wall Street investment banks. This pessimistic outlook actually means that expectations for rate cuts are still ongoing, and it might even mean more and faster cuts, right? If this leads to a more accommodative monetary environment, it would benefit both the stock and bond markets, and everyone might hold some positions in stocks and bonds. This is indeed one perspective. Let's continue to take a look. How much have non-farm payrolls been revised down? Historically, from 2015 to 2024, just last year, for 2023, from April to March 2024, there was a downward revision of 818,000 people. Honestly, that sounds unbelievable, because before 2021, if you look at the period from 2015 to 2021, even a revision of 500,000 was considered huge. Most revisions were around 170,000 to 160,000. 150,000, 200,000, usually it was under 200,000. There was a 43,000 revision, which was rare. But starting in 2022, it jumped to 460,000, 300,000, and last year the downward revisions were bigger. So what we'll look at next is for this year, 2025, the revisions for 2024. From this April to March, how much the total downward revision be? So if, as those institutions just mentioned, there's another downward revision of, say, 800,000 or even 1 million people, then that would mean 2 consecutive years of downward revisions. That's why Trump got angry and fired the previous director of the Bureau of Labor Statistics. There's a reason for this, because he felt, wow, the data really has been trending downward and has been quite pessimistic in recent months. Back then, when the data was released, it always fell short of expectations. It was consistently low. So is it because things were bad from the start, or is there actually a problem with the data itself, whether it's the way it was collected or something else? Let's take a look. This is research from Bloomberg's economics team. Right now, Wall Street is expecting that the preliminary benchmark revision released by the U.S. Bureau of Labor Statistics this year will. It will show, as just mentioned, a figure between 800,000 and 1 million. Okay, their team estimates it will be around 500,000 to 550,000. But if we compare it to the previous year, which was 818,000, and even if this year turns out as Bloomberg expects, at 550,000 then. So actually, if we look back, not just last year, the job market had already started to deteriorate. Even in 2023, the market was already getting worse, and the numbers were already lower than what was initially reported, because of the downward revisions. That means there really weren't as many new jobs as reported. Yeah, it was already getting worse. So when Trump talks about the Fed chair and calls him Mr. Tulane, actually, we put a question mark here because he's not Mr. Tulane. Why? Because he doesn't cut rates. Is it him who makes these tough decisions about raising or not raising rates? Of course not. So who makes these decisions? It's the Fed governors. The board votes on it. Interest rate decisions are made by voting, and they must agree unanimously for it to pass. Alright, so let's look at what Trump said. Out of the 7 points, maybe 3 are debatable, but that's okay. When he talks about Mr. Too late, we could actually say it's the whole Federal Reserve, like a team today. This whole team is rather slow, so when we talk about this slowness in a bit, is it really the Fed's fault? Not necessarily. But first, let's take a look. If we go back to 4 or 5 years ago, this chart is actually from 2024, but I'm using it here. Why? Let's look at 2021. Usually, when things start to pick up, what does the chairman say? He says it's crazy, and he hints that he thinks inflation is just transitory, only for a short period. But after almost a year, about 9 months to a year, by 2022, he starts to realize, oh, the data keeps going up and isn't coming down at all. There wasn't even any mean reversion, not even a slight move back toward the average. It wasn't like that at all. Instead of fluctuating downward, it just kept going up and up. That's when they started aggressive rate hikes, really aggressive. So what is this chart showing? This is the PC, the core price index. It was really dramatic before, going all the way up from 2% to over 5%. Of course, the CPI was even higher. This is the core index. So, actually, even though this chart shows the past, it really explains why the Fed had to start hiking rates so aggressively when they did. They kept raising rates in big steps, like 3/4 of a point at a time, several times in a row. Even though they had already misjudged the inflation situation back then, some mainstream economists and strategists on Wall Street had already been watching and saying, hey, was inflation starting to stir? At that time, the Fed chair, speaking for board members, said it was temporary. That's why they later hiked rates aggressively to bring it down. If they hadn't acted forcefully, things would have been worse, and it might have dragged on. Fortunately, they took strong action to save the situation, and now inflation is slowly moving toward 2%. That's what this chart is showing. So, we already know that the Fed has this kind of track record in the past. Now, could it be the same situation again? Let's compare it to what we just discussed. You can actually see this from the recent non-farm payroll numbers. Starting in 2023, if the job market has been slowing down for 2 or 4 years, and is still slowing, this year the monthly numbers have only increased by 22,000. It's almost turning into a job market recession. The employment market is already in decline. It's at this point they start to cut interest rates, so it's no wonder everyone expects this is a done deal. People think it's likely to be a 1-point cut, and some even speculate it could be 2 points. They aggressively raise rates by 3 points. Now, will they preemptively or urgently cut rates by 2 points? Will the cut be more than just 1 point? So that's why everyone is speculating, because they've done this before. But it's not a given. Mr. Tourette, or it's a team decision. Next, let's discuss why such a mechanism exists. Chairman Lennon, the committee is made up of economic experts, right? Or people who understand interest rates and the economy. Not, but most do have PhDs. We can also see that these PhDs, being academic types, have a certain characteristic, though I wouldn't call it a flaw, because they're very rigorous. They make decisions based on all kinds of research papers and statistical data. But if we compare that to Trump, what background does Trump have? He comes from business, a real estate businessman. And now, in the past year or two, there's been this trend with cryptocurrencies, right? Actually, ever since he was in real estate, of course he always hoped for lower interest rates, because that would be better. It encourages people to buy real estate, whether it's for his commercial properties, or his resorts and golf courses. All of these benefit him. A low interest rate environment means lower capital costs for everyone, and all of that works in his favor. And actually, business people have a certain trait. Their instincts are very flexible and sharp. Everyone knows that in the real world, or when given some inside information, he might already have picked up on some clues. So when he says that if interest rates aren't lowered soon, the economy will slow down, well, there's definitely some truth to that. For him, maybe there's self-interest. Perhaps he's trying to scare the public or even the Federal Reserve Chairman. But these factors exist. Most economists with doctorates will analyze things and say, let me wait and see. But what happens? They underestimated inflation and reacted too slowly. Interest rates were raised too late. Now, it's also possible that they'll end up being too slow to cut interest rates. Okay, so about this, when they say they're preparing, they're actually putting forward a candidate to fill the vacancy on the Fed's board, and that's Stephen Millan. Recently, it's possible that he could get approved as soon as Wednesday, since right now it's the Senate committee that's handling his nomination. Actually, about 6 months ago, all the Republicans were fully supporting him, but there are some differing opinions among the Democrats. So whether or not those key Republican senators can be persuaded to switch sides, to not support him, remains to be seen. Right now, he still holds some other positions, like being a White House advisor, so nothing is set in stone. That's why there are these differing opinions among the Democrats. They sent him a letter saying, given your current lack of independence, if you don't resign before September 8th, we believe you may still be under Trump's influence, and that would make it impossible to demonstrate the full independence of the Federal Reserve Board. So, it's possible he might need to fight for 4 votes. Because of the Republican defection mentioned above, that's why he still can't take office. Otherwise, he would have already taken office, and if he did, it would actually mean that Trump's influence, or rather, pro-Trump board members, would be joining the Federal Reserve. So could this change the structure? Maybe not in the short term, but it's possible he could become another voice within the board. In other words, the relatively dovish voices would grow stronger and gain more momentum. Alright, let's take a look. Looking at the market trend, if we check SB, actually yesterday, it was relatively mild. In other words, it went up. And today, because at 1 a.m. tomorrow, on the 10th, Apple will be holding its fall launch event. There are a lot of speculations about it, of course, but what has Apple always been criticized for by the market? It's that their AI development is actually far behind other major tech giants, like Google and Meta. Apple originally started out making devices, and later developed some ecosystems, like Apple TV or the Apple Watch, and products like AirPods. But these are still mainly hardware-focused. When it comes to software or AI, Apple has actually put in relatively little effort. So everyone feels that their progress in AI just isn't enough. If we look at the S and AMP wink with tongue sticking out 500 index, the largest component is NVIDIA, at 7.41%. The second largest is Microsoft, and the third is Apple. If we look at Apple's performance in the past, from August to early September, you can see that around the 203 mark, it started to find support and didn't drop any further. It began to move upward, starting a rally. During that period, it made about 2 upward moves. This is the upward trend, but usually, after the price rises before the launch event, if the actual event happens, everyone feels like, hey, it's pretty much the same as what the rumors and news had already reported. So what is everyone focusing on this time? Besides the launch of new products, a key point is their pricing strategy, whether they raise prices, and if so, by how much. That's very important. Because when we talk about Apple or Apple users, there's actually a certain level of loyalty. That's because it's genuinely easy to use, and whether it's data backup, information security, or the entire app ecosystem for developers, it's all very robust. These are all undeniable facts, and they're widely recognized in the industry. However, if they raise the price significantly, and the higher-ups have assessed that it won't affect their sales volume, then this time things might be different. But if, first of all, the rate at which they increase the price isn't actually that high, if it's not much, then it won't really provide much of a boost to overall revenue or profit margins. So moving on from that. And if they don't announce any surprises, like what exactly their progress with AI is, if they don't present a clear and impressive roadmap, and I want to emphasize, a roadmap, a plan with future milestones showing step by step how they're going to roll out AI tools and integrate them with their current devices, then people might end up disappointed again. So that's an important point we're bringing up here. Everyone should watch for possible volatility during the trading session, as this could affect related stocks, like those in the supply chain, not just in Taiwan, but also in the US market, where some companies are connected to Apple. So watch out for ripple effects. While the keynote is happening, if the market feels disappointed, it'll be around 1 a.m. our time, and the US market will still be open, especially in the latter half of the session. If it's in the first half, some ups and downs, some volatility is normal. I checked the Dow Jones, and it's hovering near its recent range, up slightly by about 0 point something %. So, It all depends on these factors. Everyone is still watching for the upcoming non-farm payroll numbers and Apple's keynote event. These are the two main things to focus on. It's the same situation here. If the Nasdaq 100 is at its peak after Apple's keynote, Apple might drop or pull back, so keep an eye on that. As for Nvidia, is it really that dependent on Apple? Actually, not so much anymore. Now it's mainly focused on data centers. So, when we talk about the biggest weights, I'm referring to the S and AMP wink with tongue sticking out 500 or some of the major semiconductor-related stocks. Of course. TVs, Apple's supply chain, yes, that's right. They're the main manufacturers, so everyone should pay attention. And within semiconductors, there are those that produce components for Apple's supply chain, whether it's for headphones, tablets, computers, or phones. Alright, moving on to our second topic for today, let's take a look at how things are performing from the perspective of the sectors. Over the past 5 days, let's pay attention here. This is the performance of S and AMP wink with tongue sticking out 500 sectors over the last 5 days, not just a single day. Some sectors have stood out, while others have been weaker, and that ties into our second topic. First, let's look at the sector that gained the most in the past 5 days, the Home Construction Index, which rose by 7.27%. Then there's home furnishings and commercial real estate. Let's read out these 4 starred sectors. Home improvement. Hey, does anyone notice something? It seems like they're all related, right? They're all connected to real estate, personal home renovations, and interior design, aren't they? They're even linked to commercial real estate. So, as we mentioned yesterday about the direction of interest rates, let's add a bit more here. In addition to being precious metals like gold and silver, and their price fluctuations, it's actually also an indicator related to real estate. If interest rates go down, it's good for real estate, a positive factor, and this benefit could continue for some time. We'll adjust the chart later. Now, let's look at something else related to what we mentioned about DPI this summer. Alright, when we talk about nuclear weapons, we can't forget Hon Hai. But for Hon Hai, in recent years, whether it's their automotive platform or other areas, they've already shifted focus. Whether it's their data centers or the assembly of servers they've rolled out, they've diversified a bit. Of course, the impact is still significant, since that's their main line of business. Alright, let's take a look. Next, looking at the weaker performers, we can see that Sinopec is somewhat related to the economic climate and oil prices. Also, let's take a look at coal and oil exploration. These two are pretty important here. They dropped by 5% and 9%, respectively. Gambling, yeah, all those gaming and entertainment stocks, the betting sector. And then there's Zenluju, which is actually quite similar to things like wine or whiskey. I'll show you these in a bit, just these few. Everyone, what I've noticed here, and why I've highlighted these 4, is actually for a reason. Besides what we just talked about, the impact of interest rates and the trends on real estate stocks, there's more to it. Let's think about it. Why are these stocks or companies seeing their share prices drop today? Could it be that the big players on Wall Street, those major international institutions and sovereign funds, have already factored in their outlook for the next month or two, or even for the present moment? The atmosphere around orders in the market has already been affected to some extent. So why is there this impact, for example? Why are fewer people, for example, going to casinos, resorts, golf courses, or restaurants? Is it because domestic tourism in the US is already facing some issues, or perhaps international tourists are visiting the US even less? That's one possibility. And what about alcohol? It's the same situation. Wine, spirits, whiskey. Are people drinking less of these too? What's the reason? Could it be that prices have already started to rise, so because of these price increases, the overall demand has dropped? There are indeed such reasons behind it, and we'll continue to explore this further. We even see this trend in some individual stocks as well. It's the same story. Among the popular sectors, we see residential construction, right? You can see there are a few main ones, these 4 companies. Actually, 2 of them, I've already talked about them before in my own WUN investment group, like D.R. Horton, which is one of the top 2 home builders in the US. And Lennar Homes as well, which tends to focus more on higher-end residential properties. As for PHM, that's Pulte Group, which I've also mentioned before. They're all in the same category. In the home builder sector, these companies actually cover a wide range of construction types, from villas to apartment residences. As for NVR, its stock price is relatively high, so we might not discuss it much today. Alright, let's take a look at the next chart, which shows the 30-year mortgage rate. It's actually hit a recent low. Here, I've pulled data from about the past 2 or 3 years, starting from around September 2023, based on what we can see now. Back then, the 30-year mortgage rate, fixed-rate loans, was about 8%. Honestly, it's hard for people in China to imagine 8%. Over there, people complain when it's over 2%, 3%, 3.3%, even 4%. But in the US, that's not the case. That actually also has to do with their house price-to-income ratio. If you have a regular job, or even a slightly better paying job, buying a house isn't really difficult. It's just that your monthly mortgage payments will be higher, and you will pay more interest. But as for your down payment and the money you can save up to buy a house, actually, it's not hard to get the home buying process started. But your mortgage burden will be heavier, so when we see a 6% rate, it's hard to imagine paying 6% for 30 years if you buy now. But what we also see is a trend going downward, and then even further down. There have clearly been 4 waves of decline, right? So this interest rate keeps dropping, everyone has started to look forward to something. If you're an average person in the US, you'd hope it drops below 6% into the 5% range. Easier to handle, right? Assuming a stable job, maybe I'm in the military. If I'm a government employee, or if nothing much changes in my job situation, then I think maybe my ability to afford a home will increase, and so will my willingness to buy property, right? I might be watching and waiting, adjusting my approach as I go. If the rate drops to just over 5%, and it can't go any lower, then maybe that's the bottom, and it's time for me to get into the market. Well, of course, for those who build these properties, or the developers and real estate groups promoting these homes, this is really helpful, especially for those with existing inventory. Here, we've provided everyone with the stock ticker and its price, over $8,000, which is considered pretty high. The others are relatively more affordable, around $100 or even just a few dozen dollars. Now, let's take a look. Actually, as we just mentioned, PulteGroup's business involves building these homes, and also providing financial services. For example, they even help those who want to buy a house, buyers, to obtain loans, so that's also mentioned here. It's quite widespread, catering to a broad range of customers. Whether you're a first-time home buyer, upgrading from an old home to a new one, moving to a bigger place, or relocating to a different area, as long as you're interested in buying a house, they basically cover everyone. Looking at the current situation, their stock price has actually been on the rise since around the end of June. Now, as for the current situation, it has completed what you'd call a base building phase, and it's looking really good, a very nice trend on the chart. Because if you look, as we mentioned yesterday, it's hard for the short-term moving averages to be broken below. If we look at the most recent time it break below, was it the 20-day moving average? Even on this day, it didn't really break below, because as you know, by the close it actually went back above. If we look further back, maybe it was around this time. If you think it did break below, this might be the only time. If you used yesterday's buying method, this could have been the last chance to buy in. Not sure if 007 can get out of the loss. Well, maybe there's a chance now, because, how should I put it, the market atmosphere is a bit different now. Alright, here we can see a financial ratio provided for this company. If you're interested in researching this company, you can look up PHA, which is its ticker symbol. Currently, its price-to-earnings ratio is 10.58, which is actually on the lower side compared to the other companies we just talked about. For example, DHI, which we mentioned earlier, already had a PE ratio above 12, and with current prices, it must be even higher now. So, in terms of valuation, this company's PE is still relatively low. But looking at it now, you should wait for a pullback before buying. If you're really interested, don't rush in. If it's really going to have another run in the future, just be patient. If it goes up, there's no need to rush, opportunities will definitely arise. Let's look at something else. Also, sorry, the title wasn't updated. We're now discussing the negative side, meaning those with weaker recent performance. We mentioned manufacturers 6363 and 6969, as well as this one. Gambling and casino-related companies, for example, or entertainment hotels, these are all tied to domestic tourism and are sensitive to economic conditions. Then there's Caesars Entertainment, CD, MGM Resorts, and even the Constellation brands. As you all know, the reason everyone is more familiar with them is because, why is that? It all comes down to the Oracle of Omaha, right? Buffett's Berkshire Hathaway has continued to buy into these companies this year, meaning he's been steadily building his position. But in the past 5 days, the returns haven't been great. It's dropped, corrected by about 10% in that area. As for the resorts, MGM is also the one that needs the biggest correction, dropping about 8.7%. Alright, next, let's take a look inside. There's a liquor stock I want to introduce to everyone, BF and NGN. Today, I'll be talking about these two. Let's start by looking at BF's ticker symbol. He says it's Brown-Forman. Actually, this company has been around for a long time. If you look at 2025, it's been over how many years now? It's already 155 years old. Such a long-standing company, its biggest business is whiskey and wine. According to research organizations for wine and spirits, what's the #1 best-selling American whiskey in the world? Jack Daniels. And then there's Hennessy. Great whiskey. Now, let's take a look. Yesterday, the stock also corrected, dropping 3.6%. But has it corrected down to its previous support zone here? If we just look at the stock price pattern, the last correction zone and the start of the rally was here, but recently, it's been facing some resistance. You can take a closer look at the PE ratio I've provided here. It's 15.69%. Actually, if you compare it to before, for investors, you can see its previous levels. For example, if it dropped from 40 or 38 down to now, recently it's reached this point. 28 yuan, right? 28 yuan is actually already in the 20s, which means the correction has been quite significant. So, you might want to keep an eye on it. The question is whether the company is really facing issues with industry sales, or if it's just that people have lost confidence in the short term. But actually, it could be a long-term buying opportunity. This is something you'll need to investigate and research further. Alright. Also, we mentioned that this company has a significant presence in the entertainment resort sector, including casinos and hotels. And not just in the United States, it's also in Macau, like MGM. So, what are they mainly preparing for? Whether it's slot machines or sports betting, they're involved in all of that. Now, if we look at the company, it's currently in a midterm consolidation phase, but what kind of situation is it still in? The lows are gradually getting higher, so I wanted to specifically point this out to everyone. However, its PE ratio has already reached 19.78, so pay attention to whether there might be a downward adjustment to its valuation. Maybe if it drops to 17 or 18, it could be a better time to consider getting in. Or, if you feel you can handle a bit more risk and think there's a chance for a rebound, maybe the recent drop was an overreaction, then you could consider it. That's the approach. Keep looking for the right timing, and as always, keep an eye on the support zone that never changes. Now, let's take another look at why I mentioned those earlier examples. Whether it's liquor or hotels, do they represent the domestic economy, or is it about the US? When it comes to these kinds of non-essential expenses, it's something we've already anticipated. Let's go back to that survey from the New York Federal Reserve we mentioned at the beginning. If the general public across the US really expects that food prices will go up in the future, and that the gas prices for my daily commute will also rise, whether it's 5% or 6%, maybe I'll have to cut back in other areas. That means, for example, I might travel domestically less often. Maybe I used to go once a season, but now it becomes once every 2 seasons, or once every 6 months. Maybe business trips will also decrease. Or, say, maybe I used to buy a bottle of premium whiskey or wine every year. I could freely pair it with red meat, white meat, or even just enjoy it when I'm relaxing or feeling down. Just open a bottle as a way to experience the pleasures of life. But maybe now, this situation could change. Maybe instead of buying a bottle every month or 2, it turns into only buying one every season. So, will overall sales volume start to decline? This might even show up in next month's or this month's CPI. Whether the CPI will reflect it that quickly is still hard to say, because this is already. Our data usually comes out with a bit of a lag, so maybe it will show up next month. In other words, prices are actually starting to show some signs of moving, and there's a possibility of a sudden unexpected increase. That's something we need to look into. Alright, let's move on and take a look at some other developments in the US stock market. Speaking of European stocks, there's this company called UV Light Technology. They've invested 1.3 billion euros in Mistral AI. Actually, Mistral AI also works on large language models, and with this investment, UV Light Technology has become its largest shareholder. They have developed their own AI models, so if anyone is interested, you can check them out. In Europe, this is the biggest player. Of course, in the US, the biggest and most highly rated would probably be something like OpenAI's GPT, or Google's Gemini, or Anthropic. These are all pretty common. In China, you have models like DeepSea from Alibaba, Tony Qianwen, and others like Doubao. There's also Tencent's Hunyuan, and all of these are available as well. But if we look at their AI investments in Europe, what is their official stance? Some analysts have asked them about this, and actually, they hope to directly apply the large models provided by Mr. AI to various departments within their company, so that internal usage can increase. In other words, they want to integrate it. Alright, next, let's take a look. Goldman Sachs CEO, Solomon, actually had some head-to-head confrontations with Trump before. Trump even said, maybe he should just go back to being a DJ, and that they should find someone else. We should find a more capable economist. Of course, he also said that his views are actually the opposite of Trump's. He said he doesn't think the current interest rates are all that restrictive. In other words, he doesn't believe they're putting much of a damper on prices or inflation. Maybe he's noticed something others haven't, because he himself has a wealth of experience in investment banking, having worked his way up from the bottom all the way to becoming the CEO of Goldman Sachs. He has his own unique insights. So he said that right now, the market's investment enthusiasm is at the high end of the spectrum. What's driving that? It's the strong expectation of rate cuts. This is just like what our online viewers mentioned earlier. There's a strong expectation of rate cuts, especially because of the non-farm payroll numbers. 22,000 is just too low, which means the market is about to cool down. That's the situation we're seeing, but honestly, the market has generally been expecting this, so it's not wrong. But could there be any surprises? We'll just have to see what happens next. Now, as for the so-called Magnificent Seven tech giants, these are the companies that are not only key indicators for the public but also carry the most weight in the indices. Right now, they're still at high levels, a bit on the high side. After continuously hitting new highs, they're now going through a bit of consolidation and some fluctuations. As for whether there will be any further developments, we'll have to see if Apple today can influence the performance of the Magnificent Seven. But honestly, I don't think the impact will be that significant, since the others aren't that closely related to Apple, and in fact, they've pretty much become independent from each other. Now, as competitors in the AI field, could it be that Apple ends up falling behind while others get the last laugh? Could that be possible? Alright, let's take a look at some updates from Europe. The European Central Bank, before it raises interest rates next year, so when exactly are they planning to raise rates? The end of 2026, it's only September 2025. So there's a year to go. They're saying the next move will be a rate hike, but not. In other words, they're going to keep things unchanged for time. So, now that the US isn't making any moves for such a long time, does that mean the Euro, the Eurozone, or the European Central Bank will also stay put? Okay, so if today the European Central Bank shifts its stance and is expected to raise rates in the future, but the US is expected to cut rates next, what would happen then? The euro would likely strengthen, and since the euro makes up a large portion of the US dollar index, at least 55%, maybe even 57 or 58%, what happens next is that people will be more inclined to short the dollar. It's more likely the euro will be bullish, so pay attention. Also, the dollar's gradual weakening is another trading trend. People might keep shorting it. The dollar's movement relates to yesterday's mention of precious metals, as they're priced in dollars. So why is the dollar weakening? First, is the US economy cooling? Second, the US holds huge dollar-denominated assets, especially US Treasury bonds. Yields on US Treasuries have dropped, so interest earned from holding US Treasuries has also gone down, right? When we buy bonds, what do we want? Fixed income. With fixed income, everyone hopes to get a certain amount each year. Before, it was 4.5% or 4.8%, but that's gone. It's not that high, just 4.2 or 4.3. In the future, will it drop further? That's exactly what everyone is worried about, so people are gradually exchanging their US dollars for other assets, or looking for more attractive options, maybe moving into the stock market. They might be pulling money out of bonds, still holding dollars, but shifting into stocks, which is why the stock market is still relatively strong right now. The high level of the stock market and its continued rise is also driven by this shift, people pulling money out of bonds and moving it into stocks. On the other hand, some people just don't want US dollar assets anymore, so they convert a portion into other currencies, like the Japanese yen, the Swiss franc, or even precious metals like gold. All kinds of options are possible, or even moving into emerging market currencies. Those are all possibilities. Okay, now let's take a look at the upcoming non-farm payroll data. Let's see if it's been released yet. It's not out yet. Hold on a second. Yeah, it still hasn't been released, that's right. Okay, so for today, at 1 a.m. there's Apple's fall launch event. Next, as we mentioned, starting in September, on Wednesday and Thursday, we'll have the PPI, the Producer Price Index, and so on. As for August CPI, which we just mentioned, is there a chance it could surprise us, or even come in higher than expected? That's something everyone needs to watch out for. It's an uncertainty. I'm looking at it from the perspective of different sectors, and the reason why these sectors have been slashed so much over the past 5 days, could it be that those institutions are already making adjustments? Alright, next up is Friday's University of Michigan Consumer Sentiment and Inflation Expectations. Okay, so, same thing here. After the market closes today, two relatively big companies will be releasing their earnings reports, and it's expected that this could impact the performance of the semiconductor sector in the Asian markets. Of course. The main reason is that information technology is still focused on semiconductors, whether it's design or related tools. As for Oracle, it reflects, actually, Oracle has been a pretty strong performer recently, and with its new earnings report coming out, it also shows whether there are any new developments in its application of AI or in enterprise software. It's worth watching. This week, on Thursday, Adobe and Kroger will be reporting as well, so everyone can also pay attention to the after-hours and pre-market sessions. Now, let's take a look at the pre-market gains and losses. Actually, there hasn't been much movement today, and it's all related to this. Fox or some news related to Murdoch, the media tycoon. Those under Murdoch have seen heavier declines, like drops of 5%, 4%, or 3%. Otherwise, actually, you can also pay attention to Albemarle. Previously, when discussing with friends or people in the financial industry, we would talk about this. Recently, of course, it's partly related to the Lee family, so there's some connection there. But whether it's likely to undergo a short or medium-term correction or pullback is something to watch out for. As for stocks that are rising, United Health might be a major support for the Dow Jones Index today. And of course, solar energy is also part of it, including things like when it comes to nuclear energy, there are some higher quality options. As for gold prices, Newmont is still leading the way. Oracle also looks good at the moment. GE Vernova is also related to nuclear energy. That's all for today's Q&A Good Night session. I'm very happy, and I wish everyone great success in your trades today and with the Taiwan stock market tomorrow. Whether the market opens strong or goes up, may your profits be plentiful. I'm really glad. Thank you to all the viewers for joining us. Yes, I'm very happy. We'll see you again at tomorrow's Q&A Good Night. See you then, bye-bye.
Our company has no improper financial interests in the individual securities recommended or analyzed. The information in this program is for reference only. Investors should make independent judgments, evaluate carefully, and bear their own investment risks. If you don't want to miss the latest market updates, be sure to turn on the notification bell and hit subscribe. In addition, we have plenty of great video content on both Facebook and YouTube. Don't miss out. In our group, we share in-depth explanations of global financial events with you every day.